Welcome to an introduction to economics, brought to you by Parkbench Tutors and narrated by David Hopcroft. For further information about Parkbench Tutors, please visit parkbenchtutors.com. In this short podcast, we shall introduce the topic of quantitative easing. The podcast is designed to complement those on money supply, and you should refer back to those for more information. There have been a number of announcements from the Bank of England referring to injections of money into the monetary system, and they are being referred to as quantitative easing. Over the 3 years from 2009 to 2012, the amount of money involved has been around £325 billion. The questions we are attempting to answer are: what is quantitative easing? Why is it being carried out? And what are the outcomes that are expected? We shall start by addressing the issue of why quantitative easing has been attempted in the United Kingdom. The economy in 2009 was in recession, and the typical response of government is to have the central bank lower the interest rates. There are a number of reasons for this. It is hoped that this will encourage spending rather than saving, and so promote sales and growth. The outcome should then encourage business to expand and employ more people, so that unemployment will start to fall. If this strategy does not work, then one alternative is to put money directly into the economy. And it is this process which is known as quantitative easing. How does a government go through the process of injecting money into the economy? The process is carried out through the central bank. The idea is very simple. The bank has to purchase something and to give money in exchange for what has been purchased. The central bank purchases assets. With quantitative easing, the assets purchased are not government bonds, they are bonds issued by banks and corporate institutions. These assets are paid for by the central bank using money that it has created. How does a central bank manage to create money? Actually, the process is simple. It simply credits its own bank account. The bonds then are supplied by commercial banks and by insurance companies who receive the money that has been created. There is no real need to print any money at this point, since the creation can be in electronic form. Having sold a bond to the central bank, then the institution that created the bond simply adds the value to its own balances. Many economists see this process as being no different from that of printing money. The central bank is still expanding the monetary base, and at the same time expanding its own balance sheet. What does the commercial bank gain from this process? The commercial bank now has more money in its own account. This money can then be used as loans to individuals or to businesses. The effect should be to stimulate the economy, since a business will have money to invest and expand, and individuals will have money to use for consumption. In terms of economic theory, the bonds bought by the central bank mean that there are now fewer bonds on the market, increasing the demand for bonds. Low interest rates should help a business to invest more, since the choice between bonds and investing in the business now favours the investment in the business. This will allow the GNP to grow, and that growth will cause unemployment to fall. If the process of quantitative easing is carried out over a period of time, then the long-term interest rates should fall, as well as the short-term interest rates. This is how quantitative easing should help make the cost of mortgages more affordable, and the injection of money should also mean that more mortgages are available. Credit growth should then start to increase and the economy pick up. Didn't Germany print money in the 1920s? And wasn't that a disaster? Should we be doing this? What about Zimbabwe? They printed money and had inflation that went out of control. These statements are both true, but in both cases the money was printed to finance government debt or public debt. If the Bank of England were buying government bonds, then it would be doing exactly the same thing. This is why the Bank of England is buying the bonds created by commercial institutions such as the banks and insurance companies. Could the Bank of England buy government bonds? Wouldn't this be safer? The answer is that this would depend on other factors. Around 1992, the European Union member states signed up to the Maastricht Treaty, which says that a government is not allowed to finance a public deficit by printing money. In effect, this prevents the government selling bonds for that purpose. The Maastricht Treaty also laid down conditions for the amount of deficit there should be in relation to GDP, and it was designed to prevent situations such as the one in Germany in the 1920s from happening again. The central bank will also hope to gain when the market recovers by selling the bonds back on the market. So, are other countries using quantitative easing? A very similar system is being used in the USA, but the term used there is credit easing. It is believed that the amount involved to date, early 2012, is around $3 trillion. The European Central Bank and Japanese Central Bank have followed similar policies, though there is reluctance from some European partners to make use of quantitative easing. Are there risks in pursuing these policies? The amount of money required for quantitative easing needs to be judged carefully, since it depends upon demands for bonds, and there is no absolute answer in terms of mathematics. If the amounts injected are too high, then inflation rises and spirals out of control. And if the amount is too low, or if the banks hold the money and do not increase loans, then the measures will have no effect at all. If only one currency were affected, then we would expect to see changes in exchange rates for that currency. It is because quantitative easing has been tried by the countries with the major currencies, dollar, euro, yen and sterling, that we have not seen any massive fluctuations in exchange rates to date. Will quantitative easing actually work? We do know there are indicators that will suggest it is working, including a fall in unemployment, a rise in GDP, businesses taking out more loans, mortgages being easier to obtain, and increasing investment. Savings rates will also be low in the early stages. A difficulty in making the assessment of whether it is working is that there are differences between the areas experimenting with the process. For example, the USA economy is very much larger than that of the United Kingdom, so the same argument may not work for both. The European Central Bank has a preferred stance of not becoming too involved in quantitative easing, so amounts injected into the Eurozone may be too small. Also, the economies of each country in the Eurozone differ, and the one-size-fits-all approach might now be tested to its limit. An alternative idea to introduce quantitative easing has been what is now popularly known as the helicopter theory. Whilst the idea is not to be taken literally, in other words, dropping money out of a helicopter is not actually what the theory is about, it does bear thinking about. If money is passed directly to the consumer, will this have more effect stimulating the economy? Will it stimulate the economy faster? The Bush administration economic stimulus package in the US was actually similar to this. This ends our podcast on quantitative easing, brought to you by Parkbench Tutors and narrated by parkbenchtutors.com by David Hopcroft. Thank you for watching and for listening. We wish you success with your studies. For more information about Parkbench Tutors, please visit parkbenchtutors.com.